What's going on, guys? Oh, did you just crack a liquid? Can we say that? I mean, we're not sponsored by them, but fuck.
I cracked an LD still.
LD still, no bubbly. Welcome to the show. Money Moves, welcome back. As always, Matty A, Mr. Breedwell, my co-host. I came straight off of a nice little golf meeting right into today's meeting with you.
Okay, yep. I was trying to get here earlier.
No, you're good.
Man, you are golfing today?
Yeah.
I've been going to the range. I'm getting the stroke.
Whoa, hold on.
Down.
You're going without me? I need to.
I gotta get.
If I know that you're playing, then I'm out there with you.
You see the hat? You see the hat?
You know I got my good on.
Can't stop the wave.
We got a great show for you guys today. We got foreclosures hitting a new high since 2019. Are we headed for a crash? There's a lot of people that are speculating this could be a precursor. We're going to dive into some of the data and unpack that. We've got tomorrow. I mean, this was a jam-packed week in the markets, first off.
Last week was pretty big.
Week was pretty big. We got FOMC rate decision tomorrow. One big group thinks we're in for a big surprise tomorrow. We're going to talk about that. We've got Russia has entered the chat with creating their own Clarity Act. A lot of people are concerned they're going to beat the U.S. While the Clarity Act sits and stalls, how that's going to impact the market. Earnings season, I mean, that's one of the biggest things going on in the markets this week. I mean, all the big juggernauts are reporting.
Last week it started with Google. It has continued this week. We'll get into that in here in a second, but it's been good.
Yeah,
it's been
a big week there. We've got chip stocks have been falling, and there might be some good opportunities to buy right now. We'll get your take on that. We've got people feeling a little bit challenged on how to read the market now under this new Fed chair. You've got some insights on that. We've got an oil update, and meme coins the trenches supposedly are coming back. We've got Ansem and Banks and Threads Guy, and Breedwell's got an interesting hot take on that. So we got a lot of stuff. We're going to hit crypto. We're going to hit stocks. We're going to hit real estate today.
Let's do it.
Let's dive in first and foremost. If you guys are in the chat, we're live streaming. What up? Say hello. Let us know where you're tuning in from.
Ask some questions.
Yeah, ask some questions. Give your thoughts, feedback.
Fly.
This is why we're doing the live stream. So we'll do some screen sharing today. Why don't we start with? Let's start with the FOMC tomorrow.
Yeah.
So FOMC tomorrow.
And a pause.
We've got
pause.
Percentages showing that there is a potential of a rate hike. We had Citadel this week came out and made a bold prediction that we're going to see a surprise rate hike tomorrow. Bank of America came out right behind them and said, no, we think that we're still going to see a pause. This is Warsh's second FOMC. So this will be another data point up on the board of how do we read this new Fed chair? How do we need this new Fed board? And based on what he said in the first meeting of we're not going to be giving a lot of forward-looking advice or guidance, we're going to try and separate that. They felt like the previous administration really was a little bit too intertwined with the markets based on the feedback and the forward-looking guidance that they were giving. So what do you expect tomorrow?
I think we're going to have a pause, and my opinion is this will be if I lay down my staff of rate cuts, but I'm going to be wrong on rate cuts that I called in January, but there's going to be a pause, I believe, tomorrow, and I think we're just going to pause to the end of the year. The whispers I'm hearing on the Warsh thing is the bears, because that's the hawkish individuals that would want that, are going to be people that are saying, hey, Warsh needs to come in, he needs to hike rates so that he can show that he's in control of the Fed and in control of the market. But I think he already did that when he stopped giving forward guidance, because he said, hey, we're not going to really tell people what the market's going to do. We're just going to let people do that in the market. And I think the thing that the market is having to digest is how does that work when we've been going so long with kind of getting, I don't know, dog and ponied to, hey, this is what's going to happen until the next meeting. This is what's going to happen until this meeting. This is what's going to happen until this meeting. So to me, that is one thing that's happening, the digestion of that. Second, Fed future rates have been so volatile.
They've been going all over the damn place.
Yeah, we've had them saying there's going to be cuts, there's going to be hikes, there's going to be pauses. Right now, futures are saying in the September meeting there's like a 55% chance of a hike. I don't think that's going to happen either. My opinion would be we're going to hold strong through the end of the year. But I don't know why we need to be that way, because consumers are still feeling the brunt of the cost of capital. And in my opinion, something's got to give from either how we retool the looking of the data or something, because we need to get lending rates down.
I mean, it's been painful being a real estate investor, anybody that's trying to borrow or leverage debt right now. I mean, it's tough when you've got, the 10-year where it's been at. Let me pull up the 10-year.
Well, the type of people it's hurting, not only just regular consumers, but I was saying like before the show, it hurts people we want to be using that type of debt, like yourself, that are more experienced, that are going to put the money to work in areas that other people are not sophisticated enough to do. And that translates through into the market.
The ripple effect that it has in so many different industries, the 10-year, I mean, in so many aspects of our economy. And I think right now, what are we seeing tone up on the screen? We got the 10-year at 4.6 today. So it's dropped a little bit, but I mean, nothing that's going to make any kind of difference right now. No. We did see oil prices dropped
back down to 79.
Yeah. So
people have been quoting the Brent as well. I would
talk about the difference between those two, because I don't think a lot of people understand that.
That WTI is the cost of a barrel of oil. Just to keep it as simple as possible. So it's like when the WTI is higher, they use that. When Brent is higher, they use that for some reason. WTI is what you should be using for oil prices. To what I was saying though, what I was saying a couple weeks ago, I think the market is also starting to digest that, because we saw oil prices spike here, but I was saying over the past 2 weeks, that's going to come down way quicker than it did last time, and it went up just as fast as it did last time, or not go up as fast as it did last time. Here we are, that was at $91, $92 a barrel when I said that. We're back down to 79, and I think we're going to continue to trend down. We did get word from Trump that there's some negotiating thing.
Yeah, we fucking heard that.
I'm about to say, I don't even know if that's how much.
I mean, the market just at least futures, when they said there was another pause on Sunday of negotiations and talks, futures
popped huge.
Yeah, futures went up nice and juicy. Mm-hmm. Monday, was there a little bit of sell-off yesterday, though?
There was. I mean, the thing is, look at Google last week. Google has really good earnings reported, right? Then we see a massive sell-off in the stock. After hours, carries through the end of the week. And I think a lot of people made the mistake of what is happening on a lot of stocks, where they're giving positive news, positive reports, good guidance, but the stock is down. So they're using that like one day as the bellwether of, oh, this is what the stock is going to do moving forward. And that's just not the case of what's going to happen. Here we are this week, and not only has it recovered, but it's probably going to push through where it ended last week and then some. And so people who are smart and would have maybe purchased that or continued to stick to their plan, they're the benefactors of that. And that's why you can't make investment decisions on one day, especially if you're holding individual names.
So with oil continuing to trend back downwards, which we know is, from my opinion, based on a lot of what has been driving and spiking inflation recently because of the Iran conflict, this is something that, do you think, based on your idea of we're going to see a pause tomorrow, that because of where oil prices have been trending since the last FOMC, that's going to be a heavily weighted factor in the decision to pause?
Not necessarily. What I'm saying is people had the Fed, the market, retail investors, professional investors are all now coming to the table and saying, hey, the energy shock that we saw with the conflict with Iran when it originally happened was not systemic, was not part of the overall economy. It was a blip. So this one that just happened is going to be a blip. And we need to figure out that even though it might give us bad data in the short term, that's not probably going to translate out into the long term. That is coming way back into range much faster than it did the last time. Because the last time we had that, the energy shock that you want to call the conflict in Iran when it started, it was 4 or 5 weeks before people started to digest that. It took us about 10 days this time. So way faster, much more risk appetite for people that have that ideal. And then what that's going to translate through in, the data's not sticking around in the oil prices long enough to give us a negative CPI report. It's not going to move the needle enough for people to care.
So with the probabilities of hikes being more elevated than we've seen them recent past, what would tie into, in your opinion, a hike? Is there any possible scenario that they do hike tomorrow? And if they were to hike, what do you think the factor would be that led them to that decision?
I don't know. I have nothing I can come up with that would make.
Because I'm just thinking, like,
there's nothing to slow down.
Why would Citadel say, "Oh, there's going to be a surprise hike tomorrow"? Like this
because they have a short on the market.
Well, there you
that's my guess. But they're selling their bag. That's my only guess. It just doesn't make any sense to call for a hike tomorrow. We hike interest rates when we want to slow the market down. So if we're not trying to slow the market down or prevent a melt up or prevent people from over leveraging themselves, the Fed doesn't have a mandate or a need to do that. I also think if they did that, it would send the market spiraling into a huge dip. I don't know how low it would go before people bought it up, but people would not, the market would not like that. Bond market's not telling us that. The stock market is not telling us that. So I just don't see that happening. I don't know anybody else. Citadel is typically pretty solid, but I mean, they're also a short seller. So I wouldn't be shocked if they have a short position.
So let's talk about then on the topic of the market, earnings. Earnings has been, I mean, this has been probably the biggest week of earnings reported, at least
this
the
year.
biggest. Yeah. Okay.
Yeah. Yep.
So, I mean, we had Visa, Coca-Cola,
Ford,
Boeing, Ford, Barclays.
We have Apple on Thursday, Microsoft, Meta tomorrow, American Tower AMT, American Tower Corporation. We got Palantir next Monday, I believe.
Come on, Palantir.
So, I mean, we have like a lot of popular names. And honestly, a lot of people like to put Catalyst and,
there's a lot reporting.
Oh, it's huge. People like to give or make up catalysts on, hey, this is what's going on and this is why the market's moving. The market typically moves on earnings, and earnings alone are enough to make the market move. So, names in the market especially. So, what we wanted to see, I was telling you, I was trying to think who it was. I kept saying SanDisk, Seagate, memory storage, chip, AI, that kind of gig. They reported today after hours. This is on Tuesday. If you're listening to the podcast, and 16% EPS beat, 16% plus, like 16.46, I think. That is going to be huge for the large cap space tomorrow, the 50 billion to 250 billion space, not the mega cap, but the large cap space, because that's going to provide assurances that if they're making money down here, probably from here all the way up they are. And then who do we have reporting after them? Meta, Microsoft, Apple, Meta and Facebook. I almost said the same thing. But we have big names, and they're probably going to be extremely profitable. My guess is tomorrow people are going to probably make some action that will move the market to the upside. That should carry through if we get positive earnings in the big names like Apple, like Meta, especially with Apple trading at a multiple almost double the S&P right now. Mm-hmm. That to me is an exciting setup for a nice little rebound and rally. The question I have in my head is this just another range-bound run to the 77 zone, and we're going to hit it,
some resistance,
and blow up a bridge in Iran, and we're trending back down to the 74.
So what do you think is the overhead resistance that
conflict in Iran?
Okay.
Yeah,
and
that's it.
And do you think we will be range-bound, the S&P, or is this earnings season enough to push us to a new tier or new level and hit some of those new all-time highs? Or do you think we're just range-bound for a little while and that's just going to be the ceiling Iran until that conflict is – I mean, because how many times have we heard we're coming to the table and we're talking and we're gonna stop bombing and then we're gonna blow them to smithereens. I mean, you were just playing that soundbite, right?
Like
that
holy
shit.
cow,
Trump
man.
is like.
Trump's like.
So, are we going to be range bound in the S&P until we have something truly tangible and final with this conflict? And I mean, shit, nobody knows when that is actually going to transpire. So how long can the market stay in this range? Or do we see a breakout or do we see a breakdown? Because you even talked about this earlier in the year of like, based on where you see, the market going and what we've seen in the recent past, this run-up has been pretty juicy. Mm-hmm. And you were expecting maybe towards the end of the year, maybe a healthy little pullback. But you also noted that we've kind of seen some of that in the past few weeks earlier than you thought it would be with that volatility. So that could that have maybe flushed some of the system out and given us a little bit more ammo to maybe break through to that next level?
Well, I think that to your beginning of your question, yes, I do think that there's enough upside to earnings to push us through the 77. So I think earnings are enough. But I also think that there's enough fear, justified or unjustified, behind inflation because interest rates have been so sticky and because that's a real thing that people are feeling, that could hinder that and keep us range bound. So that we're kind of literally riding a double-edged sword here. We need to see positive, not just, hey, we're at the negotiation table and hey, we need to hear, and ultimately it's what's going to have to happen. We need to hear Iran say they're going to commit to not having a nuclear program and not having a nuclear weapon. Stick with that, not have any incidents in the meantime, or we've already seen it. Trump just is going to double down and keep doing what he's going to be doing until he gets what he wants. Because I know he knows he can eventually get it, and I think you would be wrong to argue that he won't, because he'll do it for 2 years, I think, if he has to. Mm-hmm. He'll just keep figuring out ways to keep doing it. My opinion would be we need kind of both of those things to happen in lockstep. If they do, we have a really nice setup because here we are in August, moving into what do we have at the end of the year? Holiday shopping season.
Yep.
Kids are going back to school. We have
Santa Claus
rally. We got earnings season round 3 going into the fall. So we're going to have a strong setup going into the fall if that does happen. But we really need Iran off the table. I mean, it's enough in people's minds. They care about it enough that it matters enough. I don't think it should. I don't think oil should react as much as it is. But until we have a different way to move, 20 to 30% of the oil every day around the world, it's going through the Strait of Hormuz. We need to figure out a way to get around that.
And, I mean, they are talking about that now, right? I mean, they've talked about new trade routes.
UAE and Turkey have both committed with the United States to figuring out alternate trade routes, mainly to provide stability to global oil markets. It's not going to
matter to us as much.
It's really not. It's actually going to mostly matter to them. And China would be actually a big benefactor to that because China is the one who has hurt the most in this. Although it has affected our economy and our stock market, it's hurt China the most because they're purchasing 30-40% of their oil from Iran every single day. So they're having to shift where they get the oil, not to get too deep in the sticks, but oil quality from Iran is pretty high. It's a very good quality oil. It's not thick or muddy or sandy oil, which is what you're going to get from Russia or other areas like Indonesia. And so it affects their throughput as an economy much more than ours. Much more than ours. Ours are just our consumers are going to feel it at the pump.
I mean, shit, we talked about we put so much weight on this, memorandum of understanding. Where the fuck did that go? I mean, that was supposed to be the document that we were agreeing to and that we
both signed it. The problem is they from my understanding, they did the attack on the ship. That when it, says, he said, hey, you're doing too much, you're doing too many things and we're doing this back and forth. So we're just going to pause it and I'm going to bomb you until essentially you come back to the table and give me what I want. I was playing hardball, but now we're not going to be in this tit for tat thing. I'm just going to bomb you until you give me what you want. And I don't think he'll stop doing that.
I mean, I don't think he will either. I also don't think that Iran is going to concede their nuclear program. I mean, I just don't. I mean, their leadership, that's been one statement outside of like leaked Axios reports and news headlines of they're agreeing to this, and then every single time something like that comes out, they go, we will never concede our nuclear program. That narrative is never conceded once in this whole process. So I don't know how we're going to find any true agreement on that front, which that's where I think the biggest catalyst to all of this and how it impacts the markets, how it impacts the economy, how it impacts our 10-year treasury, how it trickles into real estate, how it trickles in everywhere, hinges on if our stance is they can never have a nuclear weapon and their stance is we're not fucking giving up our nuclear program. That's, I think, what hinges on all of this.
Well, the one thing that we haven't done yet and we started doing and we stopped is we have not instituted a hardcore regime change. And the thing that would take is probably, if we did that, I wouldn't be shocked if they put boots on the ground.
Although, I know it's not out of the question.
Yeah, although I don't think we need to. But that's what they would probably do at that point. Because the step above that is then actually bombing Tehran, which we haven't. We've stayed away from the capital city for the most part. And essentially starving their people, which that's a really not where anybody wants to go, because now
that's a humanitarian issue.
Yeah, exactly. And so now
it goes from war to like war crime.
Yeah, which is, it's not a war crime based on, we would be justified if that happened, but that doesn't mean that needs to happen to get to what. So there's other means to get what we need or what we want.
Yep.
And I don't prefer the route of harming innocent civilian lives. That just gets real messy really quick. So my hope is the current, whoever's in charge, which whoever it is, I don't know, comes to the table. I think if they don't, we're going to start seeing power plants and bridges, like he said, start getting taken out, and that's going to start really hurting the civilian population from a transportation and daily living standpoint. And then I think you're going to start seeing them doing some more tactical things, as far as maybe dropping small groups of teams in, tactically taking out leaders. I think that they would work in tandem with Israel on that. I'm sure Israel's already been getting that lined up.
Yeah, well, I know they were meeting today.
Yeah, and that's my guess. I don't know. I'm not saying I want this or don't want this. I'm just telling you what I'm guessing what'll happen.
Yeah.
With all that being said, the market would prefer what we just talked about. Conflict, cooling off, and continuing to cool off. Everybody doing what they say they're going to be doing. And then us continuing to get pauses or eventually a cut.
I think...
And earnings being strong.
Yeah. Well, I mean, overall, we're off to a good start on earnings like we talked about.
Mm-hmm.
We've got a massive week this week, so I'll be interested to hear kind of your recap of it on next week's show. I'm still of the stance that I think they're not giving up their nuclear program. This war is going to get teased out. It's probably going to escalate. I don't think boots on the ground is off the table to force a regime change.
Yeah.
And that's like worst case scenario. I'm hoping that your scenario plays out. I think it would be great for our economy. It'd be nice to just put this shit to bed.
Yep.
Find some kind of middle ground that everybody can move forward with. And we've got a nice setup for the market. And honestly, as stale and boring and flat as real estate is, and we're going to talk about that here in a little bit with the spike in foreclosures, and is this kind of a prelude to a potential crash or pullback in pricing and issues that could trickle into the real estate? I really think the real estate market has a nice setup if we can get the 10-year to come back in line, if we can get people borrowing capital at a reasonable rate. So I think there's some interesting stuff that, from a setup perspective, we could have some really bright days ahead of us, even though we've already had some really nice, recent times in the stock market, not so much in real estate. I'm not even going to say what you said when you walked in here.
We need like a 3.9 handle on the
just give me sub 4 right now.
Yeah,
I'll be happy with that. Okay, so two stocks that kind of want to get your quick take on before we move over to crypto and real estate. Semiconductor stocks really saw kind of a big pullback. Mm-hmm. We also saw, and let me see if I can pull up the semiconductor first. So SanDisk, which has been ripping this year.
Yeah, it's up like 300%, 200%, 300%.
I mean, it's been one of the darlings of this cycle. SanDisk falls over 17% on the day, now down 30% in 5 days and 55% from its record high. Are these pullbacks, in your opinion, were these way overvalued, or are these healthy pullbacks that you think could present some great buying opportunities for people who, especially in this sector, which has been a hot one, and with AI and everything that's continuing to go on in this space, you still, correct me if I'm wrong, believe that maybe not early, but there's still plenty of runway in AI, and a lot of the ancillary partnerships and companies that are tied into this space also have some runway. So with that being said, with SanDisk, is this, in your opinion, trading under its value that could be seen in the next, call it 3 to 6 months?
I think SanDisk has got a lot of it's ran quite a bit. So I think it's got some, when your valuation runs up that high, I think you have some some proving grounds to show. So that is to be determined. What it does, I was telling you about Seagate today. That one more is what I would focus on versus a stock that's already ran. I would look at something in the memory space, and that's not as big and kind of plays into AI, but also touches into a different space. Can that be healthy? Can that make money? Is that a benefactor of AI? And if so, how much? Because it's not even directly into AI. Well, we have SanDisk up about 16% after hours because, 9 or 10% after hours because they had an EPS beat by about 16%, gave super strong guidance, super strong forward earnings expectations, gave a good pipeline for Q1 next year. That's the type of stuff that the investors in the market as a whole want to see, hear, and especially from a company with a market cap of around $190 billion, which is a large cap company, but pales in comparison to a $3 trillion or $2.5 trillion company. And so what you have to ask yourself is, if this kind of company can make money in this space, can Apple, can Microsoft, can Meta? Probably.
Yeah.
Not guaranteed, but I would say probably. If a company 5% their market cap can do that, then yeah, I would say they probably have the means and verticals on their cash to do so. So that's a very positive for throughput into Wednesday. And I would anticipate that tomorrow we have a huge response to that in the chip space, because it was absolutely a bloodbath there today.
Okay, so you talked about, I've heard you say Seagate a couple times in the past few weeks. What is Seagate?
They're just a
why
memory.
do you like them, or why are you paying attention to them? I mean, I know today they're down almost 9% today, but after hours they got a
fully
bump
recovered.
Yeah. So what do they do? Why are you paying attention to them?
To me, it's nothing, not a name that we even own. We don't own Seagate, not directly or through individual holdings, but probably have some exposure through funds. But it's just a good indicator of the health of the space as a whole. So what we can see is, not only are they having good earnings and good revenue reports, but they're consistently almost better every single time, even though the environment is not as, sunny as it could be. They're up about, people have been talking about, SanDisk. Well, SanDisk is up 300%. This is 500% year to date. This is a much better play, although it has cooled off, just like SanDisk is going through now. So to see them move, this is a 200% year to date. I'm reading the wrong number. This is a good name and a good indication of what probably will happen in names similar to this. Not a massive market cap, just a little bit outside of the large cap space where they start to grow into the mega cap space. Plenty of room to grow still. Huge untapped area for what AI can do. Data storage is going to be a massive need for all the data that we have on top of what it already is now. There's a lot of things that are moving. And again, this is just memory storage.
Yep.
This isn't a chip. This isn't a semiconductor producer. They don't make the mirrors that we need to produce. They don't even make the necessary components to make AI, but they're a benefactor of AI hugely. That should be a very big eye-opener for people that are bearish, because that to me is a very bullish indicator on the chip space.
Okay, so let's talk about, the king of AI space right now. We've got NVIDIA.
Or is it Apple?
Well, they overtook them in market cap yesterday.
Today.
Or was it today?
Mm-hmm.
I know that they've been kind of trading between 1 and 2. So NVIDIA is down 4.5% over the last 5 days. What are they? 25 basis points up today. One, why such a pullback over the last week? And I mean, based on a lot of the information, there you go. There's the first one that people are asking. Is NVIDIA still a strong buy right now? What are your thoughts on that? Is this an undervalued opportunity based on where it sits today? Is it due for a pullback? How are you still feeling about NVIDIA overall?
I'm very bullish on NVIDIA. We have it as a core holding for most of our clients, even from a fund perspective, because they're 7, 8, 9, 10% of some of these tech and growth focused funds. Very bullish on it. Its multiple is now trading below where the S&P 500 is as a whole. So it's trading on less earnings than the market is. So that's a huge green flag for me. And then we were comparing it, like I said, to Apple, and Apple's trading almost double the multiple of the S&P 500, about 30 times earnings versus around 15, 16 times earnings, where NVIDIA is about at right now. So those are bullish signs to me of, hey, this stock is down, no doubt. The stock has been moving down, no doubt. But man, if you're a long-term investor, this may be a good entry point for somebody to kind of load up on that. Now, we obviously diversify for our clients, but I would be super happy to own NVIDIA in the 190s, because I think it should be trading closer into the 308, 315 range. If it really ran, we could see it go to the mid-4s, 500s. So those are realistic valuations based on if it's trading at, half of the earnings that Apple is. If you double that, well, we would be at about a $400 share price right now. And the market's totally fine with that. So if we get a good enough catalyst, if we get to where we have been with NVIDIA over the past couple of years, trading at 160, 190 times earnings, and people still buying it up and the stock still running, I definitely think it's a good buy when it's at a multiple less than the S&P. It almost blew my mind when I saw that today, knowing how much more of a catalyst they have to move up versus Apple, but people would think as Apple more of a growth tech play, when in my opinion, it's not.
Well, we'll get your recap on stocks and everything next week in terms of earnings. I think the biggest headline this week, I am fishing for real estate news right now, because there has not been a whole lot of exciting things to talk about in the real estate space. The biggest thing right now is you got the U.S. 30-year note has now traded above 5% for the longest stretch since 2007. We all know what was going on during that time. So far this year, the 30-year note yield has traded above 5% for 27 days, or 19% of all trading sessions just months ago. Markets saw 3 rate cuts in 2026. Obviously, we know where we sit today. So, it's been tough if you're a buyer trying to get in the market, and overall, I think that's where we see a lot of this stagnation right now. We did see that foreclosures have hit their highest level since 2019. We got 227,000, and this is for the first half of the year, right? This is all January to June foreclosure filings. I've been hearing some people go, "Oh, this is the beginning of the real estate market crash. We're going to start to see this number really accelerate." I think what a lot of people don't realize is a lot of the programs post-COVID that were there to help with forbearances, with the VA, there was a lot of different relief programs out there, in addition to banks being incentivized not to move forward with foreclosures, that now are somewhat just lapsing and they're expiring. So when you look at this number, Tone, if you want to pull this back up on the screen, 2019, what was going on in 2019? Well, pre-COVID, we know that there was a lot of people that were saying this is a healthy real estate market. Transactions were happening. Foreclosures weren't anywhere at a concerning number. So 296,000, this is the close that it's been since that time frame. Obviously, these are all the years that reflect what those relief programs were doing, right? Which was avoiding people from getting foreclosed on, working things out with them, pausing stuff. Whereas now a lot of that stuff is somewhat lapsed and expired. So we're seeing a little bit of a spike. But when you compare what's going on in 2019 to today, and you're calling for a housing crash or that there's a bubble in real estate, that's just not the case. I mean, it's just not something that is going to happen. If I go back over to some of my notes here, right, we don't have a market where we're seeing forced sellers. So we're at the same levels of 2019, whereas in 2008, we had 1.6 million foreclosures during that time. I mean, that is almost 84% delta right there between 2008, or actually that was 2010 in the peak, and where we're at today. So anybody that's shouting, oh, this is going to be a real estate crash, but they look at the data and go, well, we're 84% lower than where houses were when we really were in a crash or post-crash. You've got people, listen to this statistic, people have a record amount of equity in their homes at $11 trillion. We have people that have cheaper mortgages with lower rates than they could obviously get today. 4 out of 5 homeowners now have a mortgage under 6%. And we've got a supply shortage that builders cannot keep up with right now. I think there's like 3 to 5 million homes nationwide that we're short. So when you look at the data, right, the data is not screaming that there's a bubble that's about to burst. It's actually the opposite. And we're not going to see, if there is times, which we are seeing some people are struggling to get by, we're seeing maybe some emergency funds getting tapped, maybe savings accounts are lower than what we've seen previously. The one saving grace in this economy that was not around in previous crashes was the fact that there's $11 trillion of tappable equity. Even if you are having to refinance and pay a higher interest rate, that's going to happen first before people go, I just need to sell my house.
Oh, yeah.
They're going to go, no, I'm going to go refinance and I'm going to have it to, service a little bit higher of a mortgage payment. But at least I just unlocked a couple $100,000 in equity that should hopefully float me to working through whatever distress or turbulence I'm currently facing right now. And that's a backstop that the economy did not have in previous crashes, that right now, even though the real estate industry is, hemming and hawing and we're bored or we're upset or we're frustrated about, some of the dynamics that are in it right now, that is a bargaining chip that we just did not see in previous market cycles.
Yeah, I mean, I have like $800,000 or $900,000 of equity in my home, and I just bought that home or built the home in 21. So there's a huge amount of buffer. The issue is, like we've been hitting and kicking this dead horse, it's just interest rates. Cost of capital is just too high.
It is. I mean, and
it's too restrictive.
The question I think a lot of people have too, right, is this has been getting floated around for some time, is the American dream dead? I mean, I think we've got social dynamics with younger generations that are different than past generations, but I also think we have economic dynamics that are different than past market cycles generationally that are tying into this. But if you look at some of this was posted by Unusual Whales today. Homeownership has become far more expensive since 2019, with emergency repairs up 175%, maintenance up 85%. Insurance is a big one. This is fucking with a lot of people. I mean, there's certain parts in California that people are getting their insurance canceled, let alone not even getting offered access to a fair plan, which is, 30 or 40% higher than normal. And this is a challenge that's going on around the country.
Yep.
But insurance is a big deal. This is something that I know the administration has talked about working through this. I think it was Bill Pulte, who is kind of Trump's main guy in the real estate space, that has talked about, working with insurance companies to bring this number down. Because that is, I mean, fuck, how many people are really pulling on their insurance plan God forbid something happens, but it's a low probability and percentage, and yet that is a big number that people are having to pay. You got property taxes are up 31%, and then you got principal payments up 22%.
I was just about to say it's a huge factor because like every year I get a love letter from my from U.S. Bank, and they're essentially, that's who my mortgage is held with. And they're essentially saying, hey, we need a check for like $7-8 grand because your escrow balance is short because your value of your home went up. So we need more money for taxes.
We need to insure you.
And by the way, your insurance is going up slightly. Now, I've been lucky, and I'm like on top of a hill, and I don't have any trees or anything around me, and anything that can burn is quick. So I'm not getting dropped, and I'm only paying about $1,400 a year. $14 grand a year for my insurance. No, $1,400. Yeah, it's insanely cheap. But my property taxes, so like the mortgage that I got in 2021 is $1,100 more for nothing that I've done except stay in the house. The value's just gone up so much, and the taxes are so damn high.
Yeah. I mean, affordability in the housing market, it's a real problem. Yeah. And so I understand, I feel bad for a lot of people that want to buy a home, and they're looking at interest rates where they're at, and they're looking at their wages somewhat, for the most part, being flat. They're not increasing at the level we're seeing these costs increase.
Correct.
At the level of prices and where those have increased. Then you have a lack of supply to choose from. We also, are seeing, in 2019, U.S. homeowners spent an average $9,000 per year on home improvement maintenance and emergency repairs. In 2025, they had to spend $12,500. So costs continue to keep going up. Access and ability for people to get in. I mean, we got a lot of boomers that are sitting on equity in homes and are going, I got a sub 5 or 6% interest rate. Like, if I do sell, where the hell am I going to buy at? So they're going to stay put. So you got a lot of supply locked up as well. And then we have a lot of the social and cultural shifts happening. I saw that Bloomberg today just reached something. More adult children are moving back home with their parents. We've also seen multi-generational families. You've got 2, 3, sometimes 4 generations of people living on one property or in the same house itself. So it's a really interesting time, but I do think that, we're going to, real estate will have its day in the sun again. I've been saying that for some time. When we do see cost of capital come down, we'll see the engine start revving up again. And if you do have the ability to buy now and you find something that you love and you plan on staying there for, a long time, or it is an investment property that you want to hold for some time, there will be a point in time in the future where you will be able to refinance and you will be in a good position. And so I still am trying to encourage people. I hear all of the arguments and statements that people are saying of, I just want to rent and I want to be able to get up and go and I don't have to worry about maintenance. And guess what? Based on where the economy is at right now and all the variables that are in it, those arguments are very, very valid, right? I mean, they are making good points for why people are really heavily considering home ownership and whether or not that truly is the definition of the American dream anymore. So I'm curious on what your guys' thoughts are. Do you think the American dream is dead? Do you think that we'll see this kind of, trend shift in the next few years? I'm very curious to see, because again, we've always said this, when the pendulum swings one way super far, it always finds back a way to, swing its way back into the middle or, past. So very interesting times there. We got some interesting news on crypto. We've been talking about crypto being this next frontier of finance. Obviously, tokenization has really become a new thing that is gained a lot of traction, is making stocks and access to fractional ownership of businesses or real world assets. I mean, they will be doing, mark my words, in the next 18 to 24 months, the normalization of real world assets, whether it's cars, stocks, it's real estate, it's Pokemon cards, I mean, you name it, the ability to own pieces or large chunks or all of these things in a much more compliant, transparent, financially efficient manner is going to be much more normal. It feels like, what the fuck is tokenization? Still today, I think a lot of people feel that when they hear that word. But I think they'll find a way to make this a lot more normal. But a big part of, I think, this space getting more traction is exactly what we've been talking about for the last, well, you've been talking about it for a couple years now, but the last, it's really gotten a lot of traction over the last 9 to 12 months, which is the Clarity Act. And this week we had Secretary Scott Bessent say that the Crypto Clarity Act is at the 1 yard line. They're calling for Congress to pass it. We saw today Russia has entered the chat and said, we're going to beat the United States. We're going to be the ones to kind of set the table for crypto legislation worldwide. Now, whether or not anybody gives any merit to what Russia does and decides that they trust in the legislation and the oversight of Russia versus America, because we know that it's going to get done. The sooner it can get done, the better. And we've been talking about this Crypto Clarity Act, this legislation potentially being a massive catalyst for trillions of dollars to flow into the crypto space. Yeah. What are your thoughts on that? Where does this stand in your eyes? And what are the risks if we let Russia beat us to the punch?
I think it would be a great headline if Russia did something to get ahead of the curve on being whatever we are going to claim to be. But I told you ultimately, if the USA turns on the engine for crypto with the Clarity Act, that all the money is going to come and transact through here just due to transparency and regulations and risk of not being, what am I trying to say, financial injunctions put against us. With all that being said, though, I've been saying for years, regulation will bring a ton of money into it, because I don't know if it's that Charles Schwab, Franklin Templeton, Fidelity, all these huge names are saying essentially we need the Clarity Act to pass so we know what is regulated and what's not. The back end of that sentence is so we can put our clients' assets there. We need to know which clients we can put there and which clients we can't, so we have clarity on what is, no pun intended, what is going to be good for our clients long term. And once they pass that, I would expect a huge run up in that, but not only in crypto, also in the stock market, because that will lead to people believing more in tokenization, even though BlackRock has already said that they're going that way.
Yep.
Larry Fink has said it multiple times. And you're going to have the likes of all these projects now saying, hey, who are some of these big players we can come work with? You're going to see Ethereum sponsorships, and it's going to start getting real, more ingrained into the financial system as it has wanted to be, but has had the hindrance of non-regulation. With regulation, that really opens it up, and that's when we're going to really start to also peel back and see who's serious and who's not. So money is going to go to the serious players and diverge out of the non-serious ones.
Well, it is going to be interesting how, we were talking before the show started. If you've been listening and following to the show, I like to, dabble in some crypto, and I love to follow kind of some of the influencers in crypto. I mean, one of the areas that is just straight degeneracy in gambling, and I still struggle to understand how it attracts so much money and attention, which is the meme coin space. I mean, we were talking about this before the show. One of the guys that I like to follow, if you are interested in crypto Twitter, is you've got like Ansem, which is this dude right here. You've got Threads guy, and I said this on the last show too. I think people that are bringing value, education, helping people learn to understand investing, crypto, Ryan, and stocks, and real estate. You got Caleb Hammer talking about people's financial budgets and net worth, and you got Graham Steffens of the world on the financial coffee hour and all that. These people are really gaining attention and influence, and these two dudes are funny because they cover a lot of stuff in crypto. But I was telling you this story of Ansem. They had a meme coin that essentially someone spun up. Was like a coin developer, essentially a meme coin, and they gave him 80% of all of the supply, or somewhere in that range, and it ran up to a couple $100 million like within days.
Yeah.
And in many cases, you see this happening every day. I think there's tens of thousands of coins that are just ultimate scams, right? They have some narrative, they have some random JPEG and, theme behind them. You get people who shill the coin, they run it up a little bit, and then they dump the bag. They, make all the money, and everybody else is, left holding the bag, basically, and they lose all of their money. And so it's this, they call it the trenches for a reason. It's nothing good happens down there.
Mm-hmm.
And there's only a few people that benefit from it. Do you think the Crypto Clarity Act is going to kill the meme coin space?
Yeah, because there's regulation. Yes, it will. Yep. Just like you can't just go offer a stock.
Right.
In your private, there's a lot of registration. It makes it to where it's not doable anymore. So, yes, I know it will. I know that will stop that. And for good reason. It doesn't happen in the stock market for a good reason. It doesn't need to be happening in the meme coin space, because we were talking, even if the person behind the project has good intentions and says they're going to do all this stuff, it doesn't have to be up to them for it to still go bad for everybody. So that is the thing that it's going to mitigate against, is lots of rug pulls, people chasing things that they shouldn't be chasing. And if you get to the point where you can offer something, it legitimizes all those people, so they actually get focused, so money can go to places where it can benefit people, not just might benefit people.
Will it completely eliminate the whole space,
Yes.
do you think? You
Yep.
think most 99%?
It'll be
Because I'm
gone.
thinking of there's have you heard of Pump Fun?
Yeah, that'll go to
So
be gone.
Okay, so Pump Fun is basically the platform that you can spin up a meme coin on, and it's got all these narratives, and people are buying and selling on there. But it is known as the Pump Fun is known as the meme coin exchange.
It would be illegal.
It's going to be gone.
Yeah, because then you would be trading a regulated asset, and you probably don't have the paperwork filed to do so. So that's the whole point of it. It regulates it, so it provides guardrails, so that there's rules, so that people know how to play by the rules, how to win, what would be a loss. And that's good for people. That's ultimately good. The only people who don't want that are typically bad actors. There's some good people that don't want that for their prerogatives and their reasons, but the majority of people who don't want regulation are just bad actors.
All right, so as we wrap up, for all those that are watching live, we appreciate y'all. Thank you so much. Every Tuesday, 2 p.m. Pacific time, 5 p.m. Eastern Standard Time. Keep coming, keep kicking it and hanging with us. What are you paying attention to close out the remainder of the week? And how do you think that sets us up for next week?
I'm looking for earnings tomorrow. I want to see Apple on Thursday, but
what's your prediction on some of these big boys?
I think
they're all going to be beats?
Yep. And good guidance and good revenue. We might have some revenue misses, but as long as they have good EPS and good guidance, that's what the market's looking for.
Let's go. Well, I wish I could give you some fucking exciting guidance on where real estate is going next. But what I can say is there's a lot of smart money coming back into the space right now. And you know me. I've always said, I ain't the fastest. I'm not the smartest. I'm not the strongest. I just like to pay attention to the people who are, and I like to pick and pull the things that I know I can kind of bolt on to my tool belt and put to work that gives me just a little bit of an edge. And what we are seeing right now is a lot of smart money that has been sitting on the sidelines and being very patient. One, they're almost somewhat incentivized and forced to kind of come back into the space because they've got mandates in their funds and they can only sit on that capital without putting it to work for so long. But I think it's also foreshadowing some shifts in the market, some foresight that they have and where they're parking that capital. It's going to good sponsors, good operators, good asset classes. And I do think that they're also somewhat positioning for where we're going to start to see some hopefully positive movement in 2027, right? Which is accumulate some assets that still align with fund thesis, good investment criteria, good teams, good markets, good operators. And when rates do start to get a little bit of love, guess what? All the people who own those quality assets, all of those, quality funds that were positioning accordingly, as we've said before, you don't benefit when you're buying mid-green candle or at the top of a candle. That's a little too late, right? I mean, it doesn't mean that it couldn't continue to run, but it's always the people who start to park capital in the accumulation phases of a market that when those things do start to run and some of the positive tailwinds do start to come into play, you look really smart, you make a lot of money. And I'm starting to see some big funds moving capital in that way. So that'll be something we'll be continuing to pay a little bit more attention to. I'll keep you guys posted on that. But as always, appreciate hanging with you guys. Hope you guys have a great rest of your week. Keep investing in yourself and your wealth on your march to $1 million and beyond. Shit, if I could say that right. $1 million and beyond. And we'll see you guys in next week's episode. Cheers.
Cheers, y'all.